Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and now it's time to actually get your mutual fund portfolio queries answered. And with me for that on the show is Amol Joshi, founder, Plan Rupee Investment Services. Amol, good evening and welcome to the show. And before I start taking the queries, if in case our viewers want to send us their mutual fund portfolio queries, you can WhatsApp their question on 865-797-4571. That's the WhatsApp number that's flashing on your screen. We also have an email ID, which is themoneyshow@etnow.tv. All right, so let's begin. And first question of Mr. Medikonda Amol, and he wants to know what is best for 11 years retirement plan, DPF, NPS, or a mutual fund. We don't have him on the phone line, but a very relevant question. And the best mode of retirement in terms of investment instruments. What about having a mix of all of this, Amol? Will that be a great strategy?
Sure. Good evening, Kavita. Thanks for having me on the show. Coming to the answer for question of Mr. Medikonda, the instruments that he has chosen for his 11 years retirement plan are diverse instruments. So diverse in terms of your VPF is typically predominantly a debt instrument, fixed income instrument. NPS, depending on your age or depending on the choice that you make of the fund and scheme, you can have a pure debt or a mix of debt and equity strategy. Within mutual funds also, you have the entire assortment of asset classes, debt, hybrid, that is debt plus equity, as well as pure equity. I absolutely concur with the point that you mentioned, whether a mix of all these products would work. So let's go over quickly the advantages of a few of the instruments that he has mentioned. VPF, probably one of the best instruments in fixed income because of the tax saving nature of it. By tax saving, I mean the interest is not taxable on the VPF, as well as it has substantially higher rate of interest compared to fixed deposits or compared to even PPF. So that's a very good instrument to have. Second point is you can blend a two-product strategy in something like a 30-70 or a 40-60 kind of an asset allocation. 30 to 40% you can deploy your funds in VPF. Obviously, your employer has to give you that option, and remaining 60 to 70% in mutual funds. Within mutual funds, you can look at equity hybrid, or given your long-term investment horizon of 11 years, you can even look at pure equity allocation, especially if you are going to invest in a systematic manner, something similar to SIPs. You will, by doing this, you will get best of both worlds. And by taking some exposure to equity, you are likely to outpace the inflation as well over 11 years investment horizon that you have.
Amol, because we're talking about retirement instruments, it's very important for an investor to understand as to how can they also utilize these investment instruments for having a regular income post-retirement. You know, if in case you are someone who doesn't have a regular income going on post-retirement, how can you make best use of these investment instruments and have a part of your investment that's invested in these investment instruments as a part of regular income?
Right. So we covered two instruments in the previous part. Let's cover two more instruments. Let's now talk about NPS. NPS, as we all know, is National Pension Scheme. You will invest amount into NPS via lump sum or a regular manner, and you accumulate a certain corpus. Now, that certain corpus, you have two options at the end of your retirement, during your retirement, I mean. Once you retire, you can withdraw a part of corpus, 40% odd, as lump sum in your hands, and remaining corpus, about 60%, you have the option, or mandatorily you have to go for annuity. Annuity we have discussed on this very show, Kavita, earlier also. Annuity is an insurance product in which you invest a lump sum, and typically the annuity rates are around 6% also. There are around 8 to 10 annuity options, but let's go with a theoretical 6%. So if you have a 1 crore rupees in your annuity, 6% of that is close to 6 lakh rupees per annum. So you'll be able to get 50,000 rupees kind of income from your annuity. That's what you will do with your NPS corpus. In mutual funds also, there is something similar. It is called as SWP, Systematic Withdrawal Plan. Now, mutual funds and annuity are two different products. Annuity rates are guaranteed. And that's why, obviously, anything, if it has to be guaranteed, the underlying instrument also have to have that kind of guarantee. You essentially invest into long-dated government securities, which do not have any default risk. In mutual funds, however, depending on the instrument, depending on the asset class that you have chosen, you can do SWP, Systematic Withdrawal Plan, to take care of your monthly expenses or even you have monthly as well as quarterly options there as well.
Sure. Let's move on to our next question, Amol, which is from Preetham Bose. He says he's 28 years old and he wants to make long-term investment to invest till the age of 60, and he wants to know if he can take the route of mutual fund.
Yes, Preetham. Well, of course, you can take the route of mutual funds. I must compliment at your age of 28, you are already thinking about retirement. You have a good and retirement age you have given at 60. So you have a 3-decade plus long investment horizon ahead of you. You can typically to build a portfolio, we would need to know your risk appetite. We would need to know what is your existing asset allocation that you follow across various instruments that you are probably investing. But even if thinking from a clean slate, let me say that if you are going to take a plunge into world of mutual funds, I would suggest for such a long investment horizon, you can probably look at mid and small cap funds. Now, I have two recommendations for you since you have asked for the portfolio. You can invest in Motilal Oswal Mid Cap Fund. You can also, in small cap category, you can also look at Nippon India Small Cap. Now, I also want to give you, certain kind of illustration or calculation. If you start with 10,000 rupee SIP only, over next 30 or 32 years, if this portfolio generates 12% CAGR, meaning if you get a 12% return from market from this portfolio, your end corpus 32 years later will be very, very close to 4 crore rupees. So that's a significantly large amount. And of course, this 10,000 need not remain static, right? As your income grows over the years, as your career or business, whatever you are doing, as you earn more and more, you can also utilize something called as SIP topper. Your SIP can increase from 10 to 12 to 15 and something like that. So you will have a significant corpus at your hands after 32 years. My best wishes to you.
Amol, just one question. So a mid cap and a small cap fund, any other way of diversification, because he's just starting out his journey into mutual funds, and you think an index based approach rather than going aggressive with mid cap and small cap would be better for him? Because we don't have all the details also of an investor and the risk appetite he has. He's just 28, I guess that's the only information we have. But what kind of is it better to have a diversified strategy?
Right. So, Kavita, you're absolutely right. Again, we do not have all the details. That's point number one. And point number two, Preetham specifically asked about mutual funds, and that's why. So, coming to diversification, so it is not necessary to have diversification within mutual funds also, although mutual funds offer you wide variety of asset classes from debt, fixed income to equity. Even there are some funds that invest into global or international equities, and then you also have gold and silver funds. Other than that, I assume if you are a regular salaried employee, I'm sure that you do have a PF deduction component in your salary. Other than that, if you have some element of, if you have already started with PPF, that accounts for your overall diversification. But as you rightly pointed out, I would also suggest do not start with entire 100% investments into equity. You can certainly make a mix of traditional fixed income instruments. It could be PF deduction or it could be PPF, and remaining component you can go towards long-term investment horizon in the schemes and asset class that we discussed just now.
Move on and let's take Jignesh Hari's question. He says he's 41 years old and he's invested in large cap, large and mid, small cap and ELSS mainly for wealth creation, and he says the investment has taken care of inflation also. He's investing 15,000 per month, wants a corpus of 3 crores in 10 years. Again, not a lot of details, but then the way he's written down the question, he looks like he's sufficiently diversified. Okay, but 3 crores in 10 years with the investment amount of 15,000. Do you think he really needs to step up his investment?
Yes, Kavita, that's right. So Jignesh, if you're listening to this, you can also do some back of the envelope kind of rough calculations. Your SIP of 15,000 a month you would be investing a total of 1.8 lakhs per annum. And over 10 years, your capital investment is going to be about 18 lakhs. Now, this 18 lakh to become 3 crore in 10 years period of time looks very, very difficult. It is nearly impossible. Now, coming to actual hardcore numbers, your 15,000 SIP, over 10 years in mutual funds that you have invested into large and mid cap, small cap and ELSS fund. If these schemes cumulatively generate a 12% kind of CAGR from the markets, you also mentioned something to take care of inflation. So yes, over 10 years, SIP mode of investment, I'm very much hopeful that it will be inflation beating, all things remaining constant. Now, this amount is actually going to accumulate only about 33 lakhs for you. So you have to actually jack up your SIP by 9 times or even 10 times to reach your desired corpus of 3 crore rupees. There are two things you can do. Either you increase your SIP by 9x or 10x. So your SIP will have to be something like 1.35 lakhs per month or 1.5 lakhs per month. If that's not possible, then you actually have to probably take a help of a professional and realign your goals to reflect the reality. I think those are the two ways that you can take. But from this amount, it's very difficult, nearly impossible to get to your goals. Your goals should be very good idea to have financial goals, but goals also should be realistic, matching with the kind of input that you are going to invest into mutual funds.
All right, Amol, we move on and we will take Praveen's question now. And Praveen says that his goal is to build wealth for retirement till the next 15 years now. And he wants you to evaluate his portfolio. Okay, so Parag Parikh Flexi Cap, Kotak Emerging Equity, Quant Mid Cap, Nippon India Small Cap, Quant Small Cap, ICICI Nasdaq 100 Index Fund. And he's doing an SIP in all these funds.
Right. Kavita, total of all the SIPs for Praveen is about 1 lakh rupees per month. If we simply go by 1 lakh rupees per month, we'll come to schemes also, of course. This 1 lakh rupee SIP over 15 years, that's your investment horizon. At the rate of 12% CAGR, you can accumulate a corpus of about 4.75 crores, about 4.5 to 5 crore. That's the kind of corpus that you can look forward to. Coming to your portfolio, you have a significant exposure to mid and small caps. Your exposure is about 50%. You also have flexi cap and international fund for diversification. I would say you can cut down your small cap exposure from 2 schemes to 1 as you reach closer to your financial goal. So 5 years from now, you will have only 10 years in your hand. By that time, this exposure from 50% should gradually come to 40%. From there, it could come to 30%. And you can settle somewhere between 20 to 30% as you go towards your end goal. I would say, and my last comment about the one of the funds is, instead of choosing Nasdaq fund or Nasdaq composition, I can advise you to look at more broad-based index, something like S&P 500. So those are my recommendations to you on scheme. And you will be able to achieve significant corpus of about 4.5 to 5 crores if you continue with these investments over next 15 years.
All right, let's move on and let's take Indresh's question, Indresh Singh. And the funds that he has in his portfolio, Amol, are Canara Robeco Blue Chip Equity, PGM India Mid Cap Opportunity, Parag Parikh Flexi Cap, SBI Small Cap, SBI Contra Fund, Canara Robeco Small Cap Fund also. And he wants to understand if any changes that you might want to recommend. And he's also eyeing a corpus of 10 crores in 20 years. Is the investment amount enough or he needs to step up?
Right. I think it's a slight. Idresh might benefit from the one of the previous questions that we answered in this very show. Idresh, your SIP investment per month is about 10,500. You have reasonably long period of time of 20 years, so it will get you a nice compounding. But we cannot look away from the fact that just like the previous example, you are investing about 1.8, 1.9 lakh rupees per annum. And even over 20 years, your total investment itself is hardly about 35, 36 lakh rupees. From that amount to getting to 10 crore rupees is a significant jump. As per my calculations, you will be able to accumulate a corpus of about 96 lakh rupees. So let's call it 1 crore rupees. So you are 10 times away from your stated target. What you will have to do, again, there are only 2 things that you can do. One is increasing SIP by 10x. So instead of 10,000, your SIP should go to, as high as 1 lakh rupees per month. If not, then you have to, back calculate. So now I like when people kind of want to accumulate a lump sum of 2 crore, 5 crore, 10 crores. These are nice numbers as goalposts. But when you say you want to accumulate money for any particular goal, it could be retirement, it could be child's education, the better way, instead of looking at a 2 crore, 5 crore, 10 crore lump sum, the better way is what is the current expense. Suppose if you are accumulating money for a child's education, and if so and so course today costs you about 40 lakh rupees, over next 5 years or 10 years, you should add element of inflation to that number and get to a realistic figure. So I would say if you cannot increase your SIP 10x to 1 lakh rupees per month, you have to realign your target, you have to make it more realistic, and there are ways of doing it that I explained to you just now. Look at what kind of amount you will need, inflation adjust it over a period of 20 years, which is your goal, and then accordingly start investing.
Move on and let's take Kota Venkatesh's question, Amol. And the fund mix in the portfolio is SBI Small Cap, Nippon India Small Cap, Tata Small Cap, Axis Small Cap, Navi Nasdaq 100 Fund of Fund, Quant Flexi Cap. He's 43 years old, tenure or investment horizon is 20 years. The goal is 1 crore. Too aggressive and over diversified in small cap. What changes would you recommend?
Right. As you rightly pointed out, Kavita, small cap, there are about 4 schemes out of 6, and amount wise, the small cap allocation is about 80% of the portfolio. So I would say this is extreme. This is on the extremely high side. Your horizon of 20 years, it's very helpful. Small caps have long periods of flat returns and several years of negative returns also. If you are truly believer in the small cap story, in the equity story, you might continue, but I would still suggest tempering it back from 80% to something like more manageable 30 or 40%. That's point number 1. You can reduce from 4 small cap schemes to maybe 1 or maximum 2, and the additional money you can add into 2 schemes that I'm going to recommend to you: HDFC Large and Mid Cap Fund, and I'm also going to recommend to you a hybrid strategy of ICICI Prudential Equity and Debt Fund. As the name suggests, this is a hybrid fund. It invests into equity and debt, both asset classes. And because since the fund manager has to maintain a typical asset allocation, this fund does automated rebalancing of 2 asset classes. Now, why I'm suggesting this to you is your target over 20 years is 1 crore and your SIPs of about 27,000 per month. At 12% CAGR itself, you are able to reach a significantly higher corpus of about 2.5 crores. Now, since you are in a very, very comfortable position, there is no need to take the excess risk, as well as you can look at investing into a product like equity hybrid or equity and debt fund, which will smoothen out your journey. And you will not have really, the kind of anxiety that many people have during market crashes. We saw one such market crash in very recent memory in 2020 March, where globally as well as in India, you had benchmark indices going down by as much as 35 to 40%. Since you are very, very comfortable, Mr. Venkatesh, I would suggest reduce the small cap quantity, add 1 large and mid cap fund and 1 equity hybrid fund. And best wishes to you.
With that, it's time up. Thank you so much, Amol, for being on the show today, helping our viewers
Pleasure.
with various aspects of financial planning and answering their portfolio queries.